that the meeting is being recorded, and the recording will be shared with participants in a couple of weeks. And we ask that you mute your microphone while others are speaking. We ask that you raise your hand to contribute to the conversation. And you can do this, there should be an icon in your Zoom dashboard at the lower bottom, or you can use a little trick where you use for PC users and Mac users. And then we allow everybody the chance to speak and listen actively to understand others' views. And if you have any technical assistance or you can't seem to connect to audio or any glitch whatsoever, please feel free to chat me and I can support you. Thank you, everybody. And I will now hand it back over to Mike. Thank you.
Yeah, thank you very much, Melissa. And yeah, my name is Mike Ward. I work in the Climate Investment Funds in the Transformational Change Learning Partnership. Yeah, just an invitation to everybody to just kind of introduce yourselves virtually, just by renaming yourselves on the Zoom platform. And then also, yeah, just to say that that this particular webinar on scaling climate finance to support transformation, I think is really relevant at the moment, and particularly in terms of the work that the Transformational Change Learning Partnership does. The TCLP was established and is hosted by the Climate Investment Funds, and is a facilitated partnership with Ross Strategic that brings together over 400 individuals, actually representing 150 institutions, to really develop our understanding and to support the operationalization of transformational change. In terms of climate finance, I think that throughout COP26, there was a really significant focus on finance. It was often reduced to a discussion on the $10 billion commitment that was made by developed countries in 2015. Evident throughout the discussion, and in fact in the final agreement, is that there's still very substantial contestation on the definition of climate finance. What was not contested, I don't think, by anybody, though, was the enormous gap between what is currently invested in sustainable development pathways and climate responses on the one hand, and what is needed on the other. And this, I think, highlights issues of the relationship between different sources of finance, how they may support and complement each other in many different ways. One of the big challenges, I think, in this work is that there's often a kind of sense that by transformational, we just mean more money, more finance. But I think that we need to shift that conversation to focusing much more on fundamentally changing where the money is being invested and the contributions that it makes to climate neutral, inclusive, resilient, and sustainable development pathways. So with this in mind, we've developed the following objectives for this webinar. The first is to review a range of efforts and examples of institutions seeking to advance transformational climate finance. The second is to consider how different sources of finance can work together to shape and support transformational change, with a particular focus on climate action, including both mitigation and adaptation. And the third is to contribute to determining what scaled and blended climate finance could and should look like in the coming decades. And that may be a shift beyond this notion of climate finance. We may start to take up this discussion in a bigger financial landscape. So we really appreciate your willingness to join the TCLP in these deliberations. Trust that you'll both benefit from and contribute to the discussion over the next hour and a bit. And in order to help us to shape some of that discussion, it's just really useful to know which institutions the many different participants on this call have come from. It helps it helps us to kind of understand who's in the audience, and hopefully for the panel to shape some of their responses. So in order to get a sense of who's on the call, we're going to use Poll Everywhere, and we invite you. We just move to the next slide. We invite you to identify the kind of institution or organization that you're working within or with. So multilateral institution, country government, private entity, philanthropic organizations, non-profits or civil society organizations, and perhaps any others. In order to do this, there are some instructions on the next slide. And you can access Poll Everywhere through any web browser, so on your computer or tablet or smartphone. Just go to pollev.com and then / Ross Poll. That'll take you into the screen, and from there you should be able to follow the instructions, I think, on the screen, and to enter your response. And Melissa will track that. So yeah, really just invite everybody on the call just to go into pollev.com / Ross Poll and complete that. Yeah. These usually take a little while to show up, so I'll maybe just say as well that there is significant ongoing work that we will share around the climate finance, transformational climate finance work. Certainly at the end of the presentation today, a couple of other opportunities to get involved and to take forward that discussion through various initiatives of the climate investment funds and others. So we're starting to get a sense here of who's joining us. It's moving around lots, but many from kind of multilateral institutions. I suppose many of the multilateral development banks that the climate investment funds work with, the climate investment funds themselves. Yeah, Green Climate Fund, I'm sure would also be in here. And then very nice to see private entities, so private sector investors, and then civil society organizations, some from country government, some from philanthropic organizations. Very nice to engage with the philanthropic organizations. We'll pick that up in the panel discussion. Okay, it seems to be stabilizing a little bit, but yeah, well, this is really exciting, actually. The multilateral institutions, private investment, a big push to bring the private sector into the climate finance realm, and they do already play an enormous role, depending on how you define climate finance. So a big thank you to everybody for participating in the poll and for joining the webinar, as I've said. And with that, I'm going to hand over to Tim Larson of Ross Strategic to introduce and to lead the panel discussion. Tim, thanks very much.
Thanks, Mike. And really, it's a pleasure to be here today. And thank you, everyone, for joining us amidst the hecticness of the end of the year and what I'm sure is lots of Zoom fatigue. But we're thrilled to have this exciting panel here today. I think many people may be sensing that finance in the climate change space seems to be at an inflection point. The discussion is changing. It's a very dynamic field with lots of new opportunities emerging, but also emerging challenges as well. So we're really thrilled to take this pause on the heels of COP26, as Mike mentioned, to kind of do a little stock taking about what is it going to take to really achieve the types of changes that we need in the face of climate change. So I'm thrilled to introduce a panel of 4 people that we have today, and we're going to engage not in a series of presentations, but in a very dynamic discussion throughout our time together today. So first we have Katya Gracheva, who's the lead finance officer from the climate investment funds. Katya's been around multilateral finance for quite some time, having worked previously at the World Bank and in other capacities. We also have Andrew Gilbert, a partner with Energy Capital Partners, ECP, that does private investment in clean energy transitions. In addition, we've got Surabhi Menon, Vice President for Global Intelligence at ClimateWorks Foundation, who has done a lot of research into different trends around finance for climate change, including in the philanthropic sector, but also looking at other dimensions of what it's going to take from a finance perspective. And we also have Bill Weil, program strategist from focused on sustainable finance with Tempest Advisor. And even though Bill is now in the philanthropic sector, he comes from private sector investment background in different capacities. So we're really thrilled to kind of have this diverse panel to really explore the future of finance to address climate change from multiple vantage points. So if we could bring on the panelists to the spotlight, that would be great. Welcome. Let's see, here they come. So I guess to kick things off, and if people could please mute themselves when not speaking, that would be great, just so we don't have the background noise. So I wanted to kick things off by just kind of exploring at the kind of high level, how we think about finance and transformational change to address climate action. As Mike mentioned, it's not just about scaling finance, but that's an important piece of it, but it's also about thinking about how we do finance so that we utilize key resources that we have in more productive ways. And so I guess the first question I wanted to pose to the panelists is, from your perspective, what do you see as the role of finance for rapidly scaling transformational changes to address the climate crisis? And beyond the need to just scale the amount of money flowing into climate solutions, what will it take for finance to support transformational change? And I'd like to first turn to Katya for kind of any initial thoughts you have, in your position at the CIF and sitting in a multilateral institution.
Thanks, Tim, and good morning, good afternoon, good evening to everybody. And thanks for being a part of this conversation, which is very timely. You, Tim, mentioned that climate finance is an inflection point, but I think I'd like to frame it broader, that the entire financial system is in the inflection point. And a huge indication of that is, for the first time in the COP history, for the COP26, you had major finance ministers of major economies participating, like Janet Yellen speaking on climate finance issues, or UK Finance Minister Rishi Sunak, and many others with very remarkable keynote speakers from other countries, really representing a very different, complementary and important perspective to where finance is, and asking very important question where it needs to go from going forward. So I'm very new to the climate finance as a whole. I've joined CIF this year. And prior to that, while you said I was on the World Bank side, my expertise comes from looking at the mainstream finance at the institutional investor perspective from the World Bank Treasury as an asset owner and as an asset manager, public asset manager. And then later on, prior to joining CIF, leading in another GP in the World Bank efforts on greening the financial sector, engaging with the Network for Greening of the Financial Sector and Coalition for Finance Ministers for Climate Action. And I have seen firsthand how, since the point of my engaging in the mainstream finance, it has really come such a long way. The Network for Greening of the Financial Sector was launched just 3 years ago, followed up by the Finance Ministers Coalition. They have been thinking very creatively and very actively of how to change the financial sector, because there is a growing realization that has now become mainstream, that without financial sector also transforming itself systematically, we wouldn't be able to meet our climate ambitions and climate goals. Why is mainstream finance is such an important contributor? When I joined CIF, what struck me, how impactful blended finance and climate finance is in achieving goals, but also how small that sector is and how niche that sector is. Just more recently, just I think a week or so ago, conversion released its flagship event on the state of climate finance, the state of blended finance, and it has been steady for a decade of 9 billion of concessional funding. It's clearly not enough. Just as an example, green bonds is $1 trillion asset and has grown exponentially. But even with $1 trillion, it's still only 1% of the bonds outstanding, which is exceeding over $100 trillion. So we'll be looking at a very different scale. And without bringing them on board, it would be very difficult, as I said, to scale up. From my experience now at CIF, we have been thinking how to bring them on board and have identified quite a number of different challenges that hope we would be able to discuss quite a bit. So it's a huge opportunity and incredible timing that is also supported to the policy pivotal point and political support. But the challenges, the realization of the challenges, I think is also growing as well. So it's a climb for us all collectively, to a mountain for us to climb, and looking forward to hearing other perspectives and to working towards the solutions. Back to you, Tim.
Yeah, thanks so much for kicking us off, Katya. One thing I forgot to mention is I just want to encourage people, we're going to put a link into Poll Everywhere again, where people can add in questions and upvote them, because we will have a period toward the end of the webinar where we'll spend some time engaging with participant questions. Also, it's fine to encourage people to use the chat if there's ideas that you want to share or get in as well. But the poll, Ross poll, link is there where you can enter questions and upvote them. I wanted to turn to Surabhi next. Surabhi, to hear your kind of thoughts on kind of where you see the state of finance for climate change at, and kind of what it will take in order to really make the types of progress that we need.
So Tim, yeah, thanks for the question. I'd like to take a step back, if I may, first just to consider where we are in terms of climate finance right now. NDCs are sort of the planning documents that countries are using to undertake the activities they said they would do under the Paris commitments, costing those activities and financing them, and looking at what finance a country has received and how much it needs to put in place, where are those gaps. That's a massive exercise, which I think is still ongoing. We don't have all of those details in place, which means we truly do not understand the full cost of transition and what it would take to finance that. So that needs to be done. But in the meantime, at least at an approximate level, even if it might be underestimated, we know the world would need close to 5 trillion per year by 2030 in order to make the change it said it would make. And that needs to be sustained all the way through 2050. And right now, we think it's close to 1 trillion that's needed. So unfortunately, I think as Katya pointed on the bond side too, you're not seeing that shift. You're not seeing that shift that you would need. Global finance flows are close to 600 billion, which means there's a huge gap. And that gap needs to increase 8-fold to reach that 5 trillion target. So in other words, compared to historical rates where we are, we have to grow 13 times. That's a tremendous amount of scaling that needs to be done. So in order to really scale up, both the public and the private sector do contribute. In order to truly scale up, there are those challenges Katya mentioned. So it's sort of on the measurement, reporting, and managing of climate risks. That's crucial. Making sure we can properly price emissions is essential, as well as ways we could try to remove those harmful subsidies on fossils, because there is money, it's just not going to the right thing. So all of these could help with, making sure we have flows to green investments when you factor in the risk that you take when you don't. And then also that redirection of flows away from fossil to the right kinds of investments. And we've known this for a long time. It's not like the community hasn't. But this lack of progress in general to get to those trillions has come from the lack, in the past, it's been the lack of evidence, but that is changing pretty rapidly. We're much better at identifying and quantifying risks coming from climate change. The attribution is much better now. We also have a lot of good case studies and analysis at a country level too, which shows that the green economy generates better paying jobs, and if supported well, through the right means, these could be quality jobs. And then there's also data now coming, plenty of data again showing that the shift in subsidies, if they are used to support the transition of workers from the fossil side, fossil industries to the clean economy, and make sure these jobs are well paying, we will get that public support and the political will, which again, Katya outlined, that is needed to help create that transition. So this is pretty clear for those in the field, in the finance field, tracking those flows and figuring out how well to increase it. And I think this will make it a little bit easier, hopefully, to create that shift we're looking for, to move that climate finance to mainstream finance, because we're building that case and the evidence to make that transition happen.
Great, thanks, Surabhi. I wanted to turn to Andrew now. From your perspective in the private sector, just what are some of the signs that you see about the kind of the state of finance headed to climate change, and anything kind of factors keep driving that, whether it's net zero commitments or ESG, any reflections you have on what it's going to take in order to get private sector finance at the scale that's really needed, as outlined in some of the comments from Surabhi and Katya.
Sure. I think Surabhi mentioned something that I wanted to hit on, which is driving the flows of capital maybe toward carbon-free energy and investment, and away from kind of traditional fossil investment. And I really think that is critical to move things in a material way. So I think kind of in the same way that maybe consumer preferences are forcing companies, or at least encouraging companies, to establish net zero targets, to use more recycled products and materials rather than things like virgin plastics. And that is really coming from, I think, broad consumer preferences and demands. And I think investor preferences and demands can drive things in a similar way, and really drive investment in one kind of sector versus another, and really lower the cost of capital for green energy and investment, and increase the cost of capital for fossil fuels. And I think we've started to see it here in the U.S. The traditional or fossil energy sector used to be one of the largest components of the S&P 500. Today, it's one of the smallest. And I really think driving dollars away from those companies, or making it really expensive, is moving things in a material way. We see it in investments like our residential solar business, where years ago, financing for that business probably cost altogether 6%, 7%, 8%, something like that. Today, we can securitize assets in that business at 3%. And that drives a tremendous amount of growth, and in a really significant way. And so the more investors kind of demand this and are willing to pay for it, the bigger this becomes.
Great, thanks, Andrew. Bill, curious your perspectives on this conversation so far about the role of finance and what it's going to take to reach the scales we need. And then I know there's a lot of specifics we wanted to dig into later about some examples that you've been tracking, where there might be some bright spots of innovative approaches in the future, but just kind of a high-level perspective from your vantage point, both background in the private sector and philanthropy.
Yeah, thanks, Tim. And I think the question really is, when do we move this funding flow from being a niche product to being the mainstream? And I don't think we'll have a sort of on this date it has flipped, but I think it's clear that it's flipping quite quickly depending on the sector. So if you're a power investor today and you're investing in fossil power, you're now in the vast minority, whereas some 95+% of new power generation is renewable energy. I think that we have to think about these transitions that we need to make across the major areas of our economy in a bit more nuance across them. And some of these transitions are happening faster than others, and where we need to see real scale up to reach the kind of numbers that Surabhi is talking about, we need all of these sectors to be moving and rapidly. And I think it's quite interesting. Katja referenced the commitments at the COP, and they were very significant across all the net zero commitments. I think it's going to be interesting to see how in the private sector, the realization of what they've signed up to starts to kick in. You know, a net zero by 2050 sounds very far off. A reduction by 50% by 2030 sounds much more near. And as you start to look at how these organizations take a pause and think, wait, what have we just done? We've got to reduce the emissions of our portfolio by 8% every year. That's non-trivial. That means a very real shift of finance. And I think it is going to be a time very soon when we start thinking about climate finance just as finance and less as a niche.
Katja, I want to come back to you. You know, the SIF has, you know, for quite some time been really trying to think creatively about ways to leverage broader finance, whether it's other multilateral funding or crowding in private sector investments. And I'm just curious, you know, any reflections you have about, you know, kind of what's been working well, what more is needed to really, you know, leverage some of that, or really make progress on that mainstreaming, and how do we use these scarce climate finance funds that we've got to really help make that transition? And kind of linked in there, are there any kind of key challenges or barriers you see to kind of getting to where we were just talking about, where things are really mainstreamed?
Thanks, Tim, and it's good to follow all of the participants' perspectives, because I think one point of departure from the SIF perspective is that while we've made a lot of progress in the energy sectors, dependent on the sector, in the developed economies, the context is very different in emerging markets. It's very different in terms of demand for energy, and it's also hugely different in availability to finance. And let me maybe highlight the key distinctions that we see from the SIF perspective that then are informing how we look in very proactively and creatively on addressing them. First of all, on the while the renewable energy had become increasingly more cheaper over the last decade, I think it's tenfold decrease in the price renewable. In the emerging market space, the growth in demand for energy will come from growth in the fossil fuels. And just to give you an example, that the current coal energy production is 2,100 gigawatts, and right now in different stages of design or construction, there is over 500 gigawatts of new energy coming online or will come online from coal production. There are tens of thousands of coal mines operating, etc. And a lot of emerging markets will depend on the growth in the energy sector for the demand, for the development perspective, for growth, economic growth, for employment growth, and meeting growing energy demand. So that's a very different landscape than, let's say, in the US, where we see decommissioning of fossil infrastructure and divestment from fossil infrastructure. So this is one part of departure. The second part of departure is the flow into emerging market countries. And in fact, what happened with the sovereign ESG, and this is something that the World Bank has been particularly vocal when the sovereign ESG methodologies have been evaluated, it became very clear that they create perverse incentives to mainstream finance to divert capital away from low-income countries to richer countries. All sovereign ESG metrics are explained by 90% of the country's level of development. And while mainstream finance is looking at it, oh, the country has a higher ESG, which is sustainability metric that they report into their asset owners. In reality, they basically recognize that this country is more wealthier without explicitly recognizing that is. So this is something that the World Bank highlighted explicitly, and what we have documented in particular, that it has resulted to the outflows of funds from emerging market countries because they have all of a sudden are becoming more exposed as both more poorer and more exposed to climate risk. And maybe third point is, and Zerbi was mentioning, growing awareness and incorporation of the climate risks in the portfolio decision processes by mainstream institutional investors and others. The reality is what that does, and the World Bank had also wrote extensively about this, it protects the asset owners on their risk return, on their financial assets. It does not translate necessarily that risk management, climate risk management, into decisions into investing in climate opportunity. And the current statistics confirm that even with the blended finance, the flow to the mobilization of private capital by the blended finance instrument had declined substantially in the last year. So this is a much more challenging because of the increased reporting and preoccupation with the climate risks, but not with climate opportunities, is what something that we are trying to address. So in a case in CIF, we have been working very actively to try to understand the landscape of the institutional investors. And we have just completed a very detailed assessment of their views and perspectives, so that when we are coming up with solutions that rely on institutional fundings, we're actually targeting specific issues that are important to them. They're going through the transformation of their internal processes, but they also have their own mandates, their fiduciary responsibilities, and other constraints that are not very easy to address by presenting a new instrument that the money will flow. And one insight from that survey is that the awareness of blended finance instruments are very limited in the mainstream finance. And so we need to collectively do a much better work at growing awareness that while the impact is clearly demonstrated, both the ability and willingness to partake in these opportunities are very restricted by even just the flow of information between the two niches, climate finance and mainstream finance. So we have quite a lot of initiatives on the way, but we're not yet at the sort of solution stage yet.
Thanks, Katya. I wanted to, Bill, if I could turn to you, could you give maybe a one set? I think we've got a lot of finance experts on the webinar, but if you could, in a sentence or two, maybe just describe what we mean by blended finance. And then I'd love to hear your thoughts on just a quick list of some of the key challenges you see about kind of moving toward mainstream or mainstreaming climate finance, or some things that we need to pay attention to get right. So quick definition of blended finance.
Yeah, I mean, it is somewhat vague, and I don't think there's a formal official definition, but fundamentally we're talking about blending together different categories of capital. So it's philanthropic capital, it's capital from MDBs and other development banks and public funds with private sector capital. And so you kind of see how those different categories of capital can come together to fund products. And I think the challenge that I see, and Katja, I completely agree, I think the familiarity with the market in the marketplace of these tools is relatively limited. I think the challenge is that it's complicated, and doing new things is hard, and doing complicated new things is harder. And so my worry is that by doing true blended finance, where all of that money is then put into a pot, stirred up, and then put into projects, we by adding that level of complication, make it more difficult to do the work. And so where I have encouraged the work of the philanthropic contribution to blended finance is to really investigate the characteristics of the capital that we have to work. And philanthropic capital, the essential characteristic of that money is risk tolerance. And so taking that money and using it to cover the risk portion of a project development lifecycle is a way to achieve the goals of blended finance. So the philanthropic money can come in at the earliest stage, the government and subsidized and MDB money can come in the middle stage, and the private sector can come in when it reaches maturity. That sequencing effectively achieves a blend without the complication of putting all of those different monies into the same bucket. And that's the kind of approach that I would hope that as the field of blended finance matures, that we see more of that sort of approach.
Great, thanks, Bill. Surabhi, since Bill touched on the role of philanthropic capital as that kind of ability to take risks and maybe flexible, I wondered if you could just share a few thoughts on kind of what you see as the state of philanthropic investment in the climate space, and any reflections on the comments that Katya and Bill have shared.
Yes, so I think first of all, Tim, I guess in Bill's outline of where philanthropic capital comes in, what we're seeing is very little is coming in for climate change mitigation. Our own research that we did based on collecting data for over 6 years, trying to understand the role of philanthropy coming both from individuals and foundations. It's about, it's growing, but it's at 6 to 10 billion last year that we've looked at. It's less than 2% of total philanthropic giving, which is around 750 billion. A lot of philanthropic giving goes to other causes, social causes, which all make sense. But unfortunately, with climate change and the risks and the damages that you have, it's going to take away all of those gains you would get from investment in other causes. So we particularly would like to see better ways for philanthropic capital. More philanthropic capital needs to come in, and better ways for it to be used. It's going to be limited compared to what public or the private sector can deploy. But as Bill said, it's sort of that leverage. Where can you put in your money to catalyze and unlock those trillions? And that's where I think this particular discussion here is really nice, because we have that mix of public, private, as well as philanthropic ways in which capital can be deployed, especially as you go step by step and you look at what does it take to move from climate finance to mainstream? What are the barriers? Where are the bright spots? Where are those examples where we can actually look to replicate and create that ripple and that cascading flow that we want to see? So in terms of the barriers, a question that you had, where I think philanthropic capital can play a good role is sort of, we know there's limitation in unlocking public finance because of lack of fiscal space within government budgets, institutional arrangements within countries that restrict how much the government can put in terms of public spending for climate. And then I think more importantly, it's that political willingness to make the ambitious, with the ambitious announcement, the change that needs to come. And this is where philanthropic capital, as Bill said, if you look at that early stage of what shifts can happen, it's sort of that, how do you shift those social norms, create the value for the public in terms of what climate action can lead to, which gives you that support for the government to be able to take the steps it needs to take to have that fiscal space to change their budgets in ways that promote climate action. And so I think if there are ways that we support through philanthropic use, private investments, government to take those policies that then gives the right signal to the private sector that investments need to move in this particular way because there is a policy in place, then that will create, help the private sector deploy more investments. And they're making a lot of climate commitments. We saw that at the COP. So how can they responsibly take steps to act on those commitments, they need that policy signal from the government. So these are different ways where philanthropic capital can help unlock the private and the public money. And of course, for that, we really need good champions, like strong governments, in order for them to take those kinds of steps. And that's where the global community coming together, a blended global community, can help create that pressure for these steps to unlock the trillions that are needed.
Thanks, Surabhi. Andrew, I'm curious in your thoughts on, what's the role, what do you see as the role of these other, public and philanthropic sources of capital in mobilizing private sector finance, and the role of policy in how that kind of mediates, what the private sector can do?
Yeah, absolutely. I think something Bill said was the risk tolerance of philanthropic capital. I think that applies to public dollars as well, and that's really where it should be used. I think is in or where it can be best leveraged is in newer technologies and riskier investments, frankly. And I think sometimes we get, at least here in the US, we've invested a lot in tax credits for wind and solar. And 10 years ago, I think that was great. Today, we've enjoyed it and it helps our investment returns, certainly, but those are not risky projects at all anymore. And those dollars are really not needed for the most part. And unfortunately, in a lot of places, California, for example, the next megawatt of solar installed there is not really having much of an impact on carbon emissions, unfortunately. But people are doing it in part because the tax credits and subsidies are still pretty lucrative. And I think that's, it's hard to get it sort of precisely right and pull the support at exactly the perfect time. But when it lasts too long, I think you do have a lot of folks that maybe misdirect investment a little bit towards something that's working and obviously not harmful for the environment. But I think that capital could be better spent in trying to solve or address problems like, dispatchable carbon-free generation, or helping storage along, or really helping newer storage technologies, long duration type storage technologies. And not that there isn't some support for that stuff, but it's earlier stage, and those areas need more help. And so I think that's something we need to consider when developing policy.
I think it's a great point, just how dynamic it is. So what might be useful investments from a certain type of capital today could vary dramatically 5 years from now. And I think, Katya, you picked up on the difference between developed economies and emerging economies. I know the SIF, for example, has done a lot of interesting work with MDB partners in de-risking like geothermal development, trying to take that exploratory risk off that can enable different forms of private sector investment to come in behind. And so, Katya, I'm curious, any additional reflections you have, based on hearing the thoughts from the other panelists about kind of how to overcome some of these barriers and how to productively blend or use these different sources of capital in compelling ways. Thoughts on that?
Yes, also was thinking through this as I was listening to other panelists, maybe just to give you still a bit more differentiation, even within the emerging market space where we operate. There is quite a unique approach to each country circumstances, just even not necessarily from the technology deployment point of view, but the finance mobilization and finance deployment point of view. For those who are familiar with the financial system would know how important credit ratings are at the sovereign level for decision how to deploy capital. And just to give you an example that the lower middle income countries, only 2 out of those countries are investment grade. Everybody else is below investment grade. Over the last decade, you had 20
Well, it looks like we're losing
market countries downgraded. Okay. Can you hear me?
Yeah, we lost your audio for a minute, but.
Oh, sorry, my kids are now quarantined from their school, so they're now doing their schooling as well. And so the downgrades below investment grade immediately put emerging markets into a very different categories for investment. And so what that means for mobilization of private finance, which is the majority of countries in which we, for example, CIF will be doing accelerated coal transition or renewable energy integration, would require a lot more blended finance use for de-risking and for subsidizing the private sector for them to participate. And this is just one notch in the credit rating agency's assessment. This is one notch, but it puts from one part of the sort of financial assets categories into another. And you go from where private capital would go with smaller subsidies, a smaller de-risking, to going into below investment grade. And then it becomes a lot more heavy lifting for the philanthropic capital or for public capital just to bring them in on board. And within that context, it's not only that aspect, investment and below investment grade, it's also the global risk environment. Bill was talking about risk preferences, risk tolerances. I think COVID also highlighted much greater risk aversion across the investors, that even within the broader categories, they're a lot more hesitant to deploy. And I'm seeing the comment on the patient capital. That's exactly what CIF is viewing itself as a, the patient long-term capital is what's needed, rather than being driven by certain sort of parts of the finance value chain or value system, whether it's credit rating agencies, ESG assessment, etc., so that to make really transformational change and long-term investments. I'll leave it at that.
Great, thanks, Katya. In hearing this conversation, it does seem like we've got a really big lift ahead to make the transitions we need. And I'd love to pivot now to just spend a few minutes on kind of where do we see some really exciting stuff happening about new ways of thinking around this. I know, Katya, you've referenced some of the work that the CIF's done, which has been really pioneering in this space. But I'm curious to hear just some of some examples of bright spots that may help inform what the future of finance to support climate action could look like. And I've heard a number of people reference some of the recent transactions on energy transition in South Africa as potentially one, but curious, just any thoughts of examples out there that any of you would point to. Surabhi, I don't know if any come to mind for you about where you see some exciting things happening.
So since you mentioned the energy transition in South Africa, Tim, I think one way some of the bright spots that we've seen, at least, is sort of, in the way philanthropic capital or blended finance can be used to get to those early stage innovations, because to get those projects ready for investments to get to that scale we want. We clearly need innovation in technology, in finance, and all kinds of stuff areas, just because we know there's this very large emissions gap that we have to work on, and also a large gap in finance. So one example, maybe the US-India Clean Energy Finance Facility that my colleague at Climate Work, Shilpa Patel, helped with, and with other philanthropic partners. What it does is it looks at this, the blended finance part, looking at funds coming from governments and philanthropy, and helps entrepreneurs get access to that capital. I think Andrew mentioned the cost of capital, which is really one of the key things that one has to look at in order to see how you could finance and scale up activities. So what this Clean Energy Finance Facility does is looks at various types of interventions. I think Bill mentioned some of those different stages. So it looks at all of those different stages, and then what kind of catalytic support would you need to address those gaps that you see at that different level within the market. And it mostly is used to help support those nascent companies or those entities that are new to the space, trying to, those new entrepreneurs that need to understand what does it take to start, find out ways to access the capital. And once you access it, as they grow through the different stages, what kind of financing is best suitable for that, and how does that blended product help them? So then it creates the market. Once those entrepreneurs are successful, it creates the market for those products. And then hopefully on the renewable energy space, India, because it's India, just, with the COP announcement of net zero by 2070, the pressure on the renewable energy side is going to be huge, because that's what is going to help India reach its goals. So that, finance facilities to help that kind of scaling up in the energy sector will be massively important.
Great, thanks for that helpful example. Bill, I wanted to turn to you. I know you've been involved in an effort in Southeast Asia. I wondered if you could talk briefly about that.
Yeah, really, really happy to. I want to make kind of two gating comments. One is, I think we need to remember that the subsidized or catalytic finance that we are putting to work here needs to constantly be seeking frontier markets. And that can be frontier markets in geography, in technology, in size of transaction, complexity of transaction, credit risk on the counterparty, whatever the frontier, the next border of opportunity, we need to be pushing that out and out and out. And then behind us can come the flood of larger private sector money to take up that opportunity once we've proven that those transactions aren't quite as risky as they feel that they might be. And then the second point I wanted to make was, you heard the numbers from Survey. Philanthropy can't do this on its own, right? It's the ant on the back of the elephant. It is never going to be able to move markets on its own. And even when you look at the massive numbers out of the MDBs, they can't do it on their own. So we have to think about how we maximize leverage of the monies that we put to work. And so in Southeast Asia, we developed a vehicle called the Southeast Asia Clean Energy Facility. Forgive me for not having a more fun name, but it describes what it does at least. So CCEF, SEACEF.org, you can see a bit of the detail there. We've brought together initially some philanthropic funders to fill what we saw in the field as a big market gap. And I kind of look at the project development cycle as an assembly line. You start with the folks on the ground, finding the sites, doing the hard work of getting the land access, doing the grid study, doing the solar or wind study, et cetera, on and on. And then at the end, when you reach financial close, you have the actual funders of the main project. And I feel that particularly in the developing markets, but this is commonplace as you've seen this cycle play out even in developed markets, you have a lot of money sitting at the end of the assembly line, ready to put those 100 million plus tickets to work, sitting at the end of the assembly line with their arms folded and looking cross and saying, wow, there's no bankable projects for us to do work into. And you look down the assembly line and nobody's sitting at those first seats. And I've invested into early stage project development, and I can guarantee you it is in fact more difficult to get the hundreds of thousands of dollars needed to do that early stage work than it is to the hundreds of millions once you have a fully permitted project. And so the CCEF facility is developed to invest into that early stage of project development. And by doing so, we have designed it to crowd in capital. We always insist on match funding into those projects. It starts to cultivate around us an ecosystem of both developers of projects and investors who are comfortable and confident to invest in the early stages. And then it develops that pipeline, that assembly line of projects for the larger financiers from the private sector and multilaterals at the point of financial close. And so in concept, what we're looking at are multipliers on our money in the order of hundreds of times. So right now we've got 5 million put to work so far in our first year, which will catalyze some $3.8 billion worth of assets. So if you look at those kind of multipliers and you start to multiply that out across regions and across vehicles, those are the kinds of multipliers that we need to be thinking about in terms of putting the risk capital to work in ways that catalyze the much larger flows.
Thanks, Bill. And that's exciting to hear. I know that there was some recent Overseas Development Institute ODI study that just talked about the challenges of really getting the leverage that's needed. So it's exciting to hear some examples out there. Andrew, I'm curious from your vantage point, any bright spots or innovation that you're seeing, even if it's just shifts in ESG commitments and how that's changing the conversation in private sector actors?
Sure. I a couple points I'll make. I mean, in terms of bright spots, in developed markets, I think there's maybe less of a need for some of this, but I still think it's really helpful, in especially smaller projects. So, for example, we recently financed a community solar and storage project in the state of New York with New York's Green Bank, and there I'm not sure I'm convinced they gave us a better deal overall than we would have got from private lenders. But what we did get is a lender who really knew the kind of policy regime that we were relying upon, and didn't need to spend a bunch of time learning it, getting convinced of it. We didn't need to sort of battle for the lender's attention. And it just made the whole process overall much more efficient. I think given the size of a project, it would have been hard to get the attention of a large institutional lender, given all the other stuff they have going on. And I think hopefully that project will serve as a template for the next deal, and it won't have to come from the state entity. I think that's a good example of, even though we have a project in a developed market, even though the cost of capital is maybe similar, it was still really helpful to have it come from New York's Green Bank. And then I think Tim, you mentioned it, the kind of corporate net zero goals and so on. I think that is extremely critical to driving a lot of this on a large scale. And I think there are obviously many companies have adopted these sort of policies, but I think there's a big question amongst the next group in terms of what policy should they implement. And I think there's a whole host of companies that really want a strong ESG policy, a net zero policy, but kind of don't know where to look, and maybe don't have the resources that a Fortune 500 has to hire somebody to figure this out. And so I think a way to maybe drive further support for a lot of this is providing some of those companies with a reliable, efficient way to develop such a program. And I think there's a real need for that.
Yeah, that's a great point. I know in some other markets, whether it's kind of global seafood sustainability or forest products, there has been fragmentation of standards, and that can cause market confusion around these signals. And so it does sound like that call to really have concerted attention to what are the standards that really will guide how people assess progress toward net zero commitments, and ESG requirements does seem like a powerful signal to enable private actors to really engage. Katya, I wanted to create space if there's any bright spots or examples that you're thinking of that might point to future directions where we can go with finance to address climate change. And then after that, I'd like to turn to a couple of the great questions that have been coming in from participants in the audience.
I think I'll keep it really short, and maybe focus on what we would like to see from the CIF perspective. the great transaction is probably what we would like to put together, where we would have addressed a number of different issues that I've outlined to bring money into emerging market economies and to actually have a successful instrument vehicle that will bring in institutional money, not just at the project level, but at the fund level to emerging market for climate impact. This would be a very challenging undertaking because the ecosystem for such instruments does not exist. And it would require quite a lot to put together. But I think innovation needs to happen not only at the project level, as been described very well by all other panelists. I think it's for us to bring in mainstream finance into that. They operate in a very different frame of mind. They don't necessarily look at the project specific, especially if they're small size. So there needs to be intermediation between blended finance vehicles or climate investment funds and institutional investors that would be new in its kind, and it will be using public sector capital very differently rather than deploying and subsidizing specific projects.
Thanks. I wanted to turn now to some of the questions and comments that have been coming in from participants. There's been some great questions and comments showing up here. And the first one I wanted to put on the table is related to the role of kind of really downscaling to local levels finance availability. At the beginning, Mike talked about, what really would make finance more transformational to address, some of the key issues. And there's been increasing attention to kind of alternative economic models or thinking about how to really engage people in local communities, whether it's forest communities or coastal communities, and really being a part of climate solutions, investing in micro enterprises, having resources at the community level to really engage. And I know that's particularly important in, say, low-income countries and enabling them to be a part of the solution as well. And so I'm curious, any just reflections that any of you have on what will it take to really mobilize finance, not just for these big national infrastructure questions and large scale power generation and things like that, but really get money down to the local level and engage local participants and really helping identify and co-create what the financing mechanisms and systems that can really support local scale climate action. So anybody want to take a first stab at response to kind of how to get money to the, what it would look like to really scale local finance? Katya?
Well, sure. I'll there is hesitation. Maybe the way I read it, this question is slightly different than you, Tim, is not just to deploy through the local communities. I think it's a no-brainer, and I'm aware of lots of different initiatives that are underway to do this. I think from the perspective of mobilizing local financial institutions to make that available, again, I think that the picture is very different if you go into low and lower middle-income countries or low countries, and the World Bank, in my previous role in particular, we have been involved quite a bit in helping local capital markets to develop. And the challenge in emerging markets and mobilization of local capital is underdevelopment of those domestic capital markets, especially in a low range. And the institutions that we have been working with, such as pension funds and others, are often facing even more stringent constraints on how they deploy capital. They don't usually go into private projects and quite often invest in their domestic sovereign bonds for a variety of reasons. So we've been working with them quite actively on helping them to address their regulatory constraints so that they can be mobilized. And we have been working, I think a couple of examples come to mind. Consortium of pension funds in Kenya in particular, because they are very fragmented, very small, and lack perhaps expertise to deploy in this kind of projects that would need local financial institution participation. and to address constraint at the consortium level, and to see how we can deploy. Similar efforts I've been involved in is, let's say, in the island nation, specific islands in particular, how to deploy their assets for cross-border investment, for resilient infrastructure, and for others. So it's assets are there, but they also a number of regulatory and sort of capacity issues that we're working to overcome, and absolutely agree that development of local markets, capital markets, and local financial institutions is key, in addition to cross-border investments.
Thanks, Katya. Any of the other panelists have thoughts you'd like to add into this one? All right, well, we can come back to that. I wanted to pose another question I saw up there about the just the more limited nature of finance flowing to climate adaptation needs. And I think that whoever posted the comment referenced that you know, we've got a lot more of climate finance headed toward mitigation focused activities, although I think that may be shifting some. But particularly as we think about crowding in private sector investment, the vast majority is really more focused on the mitigation approaches. And so just curious about kind of how you see the future of what it will take to really scale investment related to adaptation, and recognizing that there's often an interplay between mitigation and adaptation as well. So anybody have initial thoughts on that on the panel here? Katya, you want to take it? I know that, you know, from the SIF perspective, you have the...
I'm afraid maybe my SIF colleagues can come in. Mike, I don't know if you can. I'm afraid this is not the area that I have been involved in. So I would not opine on something I don't have direct expertise in.
Mike, did you have any thoughts you wanted to share on that?
Yeah, I think it's a big discussion that needs to happen. I think that one of the challenges is how we value ecosystem services, some of the kind of basis for adaptation. And the trick in valuing that is going to be in a very unequal economic system to make sure that we don't, I suppose, value something in a way that allows it to be kind of captured by elites. So it's a big issue, I think, and I think that it bears some investing in understanding how do we recognize the value of adaptation services, a broad range of them, and at the same time ensure that we don't further marginalize local communities, groups that are already marginalized by much of the economic system. Or particular economic system. So yeah, great question. I think it deserves work.
One thing I'd add is that there might be an exciting opportunity for more mainstreaming on climate adaptation funding. You know, we've seen some exciting trends in some of the MDB projects around climate proofing, transportation sector investments, or health sector investments, or agricultural interventions. And so I think there's a lot of opportunity for kind of integrating thinking and technologies and approaches on climate adaptation into some of those more mainstream types of development projects out there. Let's see, a couple other questions. We've got a few more minutes. One is understanding that sectors behave differently in terms of mobilizing local resources, such as energy and forests. What are some of the strategies to encourage local investors to participate in climate change initiatives? Any thoughts on that? That's received a number of votes.
I'll maybe share what I was seeing in prior. The Coalition for Finance Ministers for Climate Action and Network for Greening of the Financial Sector, I think, is now includes more than 100 finance ministers and in central banks and financial regulators. And there is huge effort underway in greening the domestic markets as well, across the board, not just in emerging markets, but globally. And there is, from what I've seen in both in the World Bank and the IMF, is to include the climate issues in all of the country assessments and country recommendations that they do. So it becomes a much more holistic way to help countries think through not only their vulnerability to climate change, but how they need to green themselves, including their financial system and each institutional sort of posture in this. And there had been quite a lot of discussion on very granular ways of how encourage local institution, domestic financial institution and domestic systems to evolve from taxonomies, green taxonomies to regulation and other initiatives that have now been globally aligned and cooperated on.
Good, Sarabhi?
If I may just add a comment to that. I think it's a good question. We absolutely need the local context for any of this finance, just because the one thing is any kind of transition, if you're not thinking of equity and outcomes for vulnerable communities affected by that transition, that's going to be a problem in making that transition sustainable. And in a lot of, especially low-income countries, there's the lack of social safety nets, a lot of informal workforces. So in many of those countries with past for example, agricultural sector, and also looking to do energy transition, issues are going to be pretty compounded. And if those communities are not part of the story of, how they might be left behind in the transition that is going to happen, then that will be a problem. And it's not okay to have that kind of a problem. So I think that identifying those local needs and making sure that finance is suitable for that transition and is going to the right places and getting that workforce, the retraining, and all of those risks that come from, for the communities who are being transitioned. Getting that addressed will be hugely important to have that greater participation.
Yeah, thanks, Sarabhi. And I really appreciate you raising the equity and just transition dimensions of thinking about finance. I know that's been of important attention in some of the SIF's thinking around this, but I'm curious if any other panelists, if anybody else has additional thoughts on kind of what it would take to really ensure that we've got sufficient finance going to, or that all finance is considering those equity and just transition dimensions, and that we're investing in solutions that help take us in those directions. Any additional thoughts on how to factor those considerations in? Go ahead, Andrew.
Sure, Tim, I wanted to chime in at least on the local component, and maybe it doesn't address a specific question and is more of a developed markets sort of view, but I wanted to mention community solar because I think that's sort of an innovative solution to kind of the local involvement, and that's been a pretty successful policy in a few of the states here, where we really do have projects that are made available to people who otherwise wouldn't have access to or don't have the capital necessary to finance an entire project, for example. In most cases, they are only eligible if they live in a particular area or are within a certain proximity to the site. I think that's been really successful and something we hope will be adopted by more states.
Thanks, Andrew. Any other thoughts on these questions? Otherwise, there's one or two questions additional questions we might be able to sneak in.
Yeah, I just kind of want to take the bigger view of wrapping in a few of these questions, whether it's adaptation investments or local investments. A lot of this comes down to familiarity and scale and proof. And, I feel like we've got an awful lot of capital sitting there waiting, now officially looking actively for net zero or ESG or some sort of clean investment opportunities. And the challenge of access to that pool of capital from local markets is very real. And it reminds me, Andrew mentioned the securitization of solar. In the early days of solar, for those of us who've been around since then, trying to get funding for a rooftop solar project was insanely difficult, right?
Mhm.
Oh, it's too small, the complexity, who knows who your counterparty is and what's their credit worthiness. It's so difficult. Now, as Andrew mentioned, you can get low single digit rate of cost of capital money to access that. And so I think what we need to do is accelerate the transition from this unfamiliar, small, disaggregated, risky, perceived risky transaction to aggregated, standardized, at volume money, and then we can see real capital flows. And so I think it's much more a question of financial facilitation rather than climate even. It's really, can we securitize in some way? Can we help local projects, adaptation projects at the frontier, whatever it is, get through that barrier of risk perception and to a scale that is relevant for private funders to come into? That's the challenge before us.
Gotcha. My sense is that's been core to the SIF's DNA, and I'm just curious if those comments from Bill resonate with you, and what you see as the role of climate finance to kind of help with that kind of rapidly shifting perceptions of risk and kind of helping capital, see new opportunities in more productive ways.
No, I fully agree with Bill that the risk is in the eye of the beholder, and it's not a truism to say that something is riskier than the others. And I said the last comment coming in is Africa is a risky country, and how can we mobilize finance to that? The problem is the current structure of the mainstream industry is anchored around very few actors who decide the riskiness. This is, I mentioned, credit rating agencies and ESG scorers that basically, with the score, 90% explained by the country's level of development. So if you are in a poor category, by default of using the services of those providers that are embedded in the financial industry, you would be put into the risky category. And that's the comment of investment grade and below grade, which is quite arbitrary. Why is that particular cutoff time one notch below? And this is and puts a very different focus on the countries. And absolutely, we noticed in the discussion here was how something that was perceived risky and as a result costly just a decade ago is no longer so. And this is a very important part of SIF mandate is to bring awareness and bring together, go into the frontier markets, go into the frontier technologies, and by learning by doing once and demonstrating by doing twice is to start shifting that perspective. I don't think mainstream financial industry will be able to shift to green itself beyond just funding green projects, but it needs to green itself without shifting their own perspective and global perspective. So this is transformational change. And so it needs to start with the system itself.
Thanks.
Tim, can I just
Yep.
piggyback onto that? I mean,
Sure.
To me, the two parts of this story that need to be unlocked are, one, origination and deal development. And I think that's where we need to firstly focus on, the highest catalytic piece, early stage of the project development. And the second is to disaggregate the levels of risk that are perceived and start to think about how do we put, rather than low guaranteed money into a subordinated part of the stack, think about guaranteeing against a specific slice of that risk. Because as you peel away those risk layers, the cost of capital naturally declines, and you get a much, much greater leverage on the monies that you put to work. And in fact, because we know that the risks are much less than they are perceived to be, you probably don't even end up giving any money into that guarantee. So those would be the two interventions that I see: early stage project development spend and underpinning on risk.
Great. We've got about 3 minutes left here. And what I wanted to do was just create space for each of you in 30 seconds or so to kind of share, reflecting back on the first question about what will it take for us to really kind of rapidly move in the direction that we need to go with finance. So anything you'd like to leave participants with that about kind of, that's if you had the magic wand or things that you think are a thing that you think is really vital to focus on to move us into the future of the role finance could play. So in 30 seconds for each of you to take a run at that. Anybody want to go first?
I think I just did.
Okay, great. So building on what Bill just said, anybody?
Sure. I don't want to leave the audience with the how challenging these issues are. And I'll leave it with the sense of possibility and opportunity. When I entered the financial industry, I've never imagined the financial industry looking at climate impact or even using word sustainability as a part of its lexicon. And it was quite a stark difference between the trading floor and the World Bank Treasury where I was versus the trading floor of a Wall Street firm. Right now, Wall Street firm is speaking more like the World Bank than the World Bank does. And I think it's a huge, huge journey that I didn't anticipate for financial industry to do. So the challenges are enormous, but we've walked an impossible path to get here right now. And it's an opportune time for us to roll up our sleeves and take it to the next chapter.
Thanks, Katya. Andrew, you want to take a next step?
Sure. Yeah, I think for me, two areas which could be extremely helpful are just trying to help better establish a policy that smaller companies, more companies can adopt on climate change, on net zero targets. Something that is reasonably malleable and easy to understand and kind of verifiable. So giving companies a template to follow. And then I also think investment in earlier stage technologies, riskier technologies that if successful could be leveraged in a really material way. I think infrastructure projects are great, but they're capital intensive, and so the dollars invested in them really don't go as far, and they're also less risky. So I think finding private capital for those should be a little bit easier. So steering philanthropic dollars and public dollars toward riskier earlier stage investing is kind of where I think it should go.
Great, thanks. And Surabhi?
I think I'll go with the cliched carrots and sticks approach. The carrots being, how do we create that enabling environment to have that transition happen? So it's sort of that public engagement, political will, the economic case for why the transition needs to happen, and making sure dollars are deployed to support that. And then the sticks being that accountability and holding to account. If we're saying we're committing to net zero, what does that mean? Why are we not doing it? What does it take to standardize data, methodology, metrics, reporting, transparency, so that you can then hold to account what needs to be done, and then sort of move towards that mandated disclosures, so that can really help transform or make the finance transition happen faster.
Great, thank you. And I just want a sincere thanks to this just amazing panel that we have. It's really been an honor to spend the last hour and a half with you all exploring these really important topics. So thank you. I do want to just mention that we have recorded this webinar, and that will be made available on the SIF website. All participants and people who registered, many of who were not able to attend, but who expressed interest in this, will have access to this. And I think we also are hoping to synthesize some of the key points made during this, given this is just such a hot topic in so many areas, and share that out as well, along with some of the resources that were flagged and some more information on some of the examples that were mentioned. So, so I think that this discussion can have impact beyond those who were here. And I want to thank the audience just for the thoughtful comments and questions that you've provided. Just to wrap us up, I'd like to turn over to Sarah Moyne with the SIF to bring us home.
Thank you, Tim. And a huge thanks again to all of the panelists today for this excellent and very timely discussion on scaling climate finance for transformational change and the sort of need to nuance the idea of climate finance and where it needs to go. As we move towards closing thoughts, we quickly wanted to look back and sort of highlight a few of the TCLP's achievements this year. As most of you may know, the TCLP published a learning brief on transformational change concepts. Building on this work, we hosted an open webinar on transformational change guidance questions and 5 interest group webinars that focused on advancing transformative evaluation and learning, transformational change signals, and signals related to the CIF's 3 new programs. The TCLP also published 2 new case studies, the contribution of the Forest Investment Program to Forest and Climate Goals, and transformational change in concentrated solar power. You can find these publications on the CIF website, so we do encourage you to share these within your networks. Moving forward, we're looking to operationalize some of these concepts and to really shape and guide investment plans in the new CIF projects. Next slide, please, Melissa. So over the shorter term, the discussion today really provides an excellent segue into an upcoming Global Energy Storage Program workshop on December 14th, which will essentially focus on the unique aspects of energy storage finance and the relationship between private capital and concessional financing. So with that, I would like to thank everyone again for joining and really encourage you to participate in upcoming calls and opportunities for engagement. As Tim said, we'll also be making the recording and some additional materials available on the TCLP's website if people are interested in seeing those. So again, thank you very much.